The markets are currently closed, but the last trading session left us with a figure that is impossible to ignore. Intel Corp closed at 40.56 USD, ripping higher by 3.78 points or roughly 10.28% in a single day. If you have been watching the semiconductor space for the last few years, you know that a double-digit intraday gain for Intel is not just rare, it is a statement. For the longest time, the expectation surrounding Intel has been one of slow decline, a legacy giant struggling to keep pace with the nimble innovators in Taiwan and Silicon Valley. The narrative was simple. Intel missed mobile, they fumbled their process leadership, and they were bleeding market share to rivals. That was the expectation. But the reality we are looking at this weekend is starkly different. We are seeing the first concrete signs that the massive, painful restructuring under Pat Gelsinger is not just a corporate exercise, but a fundamental shift in how the world's most important technology is manufactured. The spark for this latest explosion in price isn't just a generic earnings beat, it is a rumor that strikes at the very heart of the global chip supply chain. Reports surfaced late Friday from prominent analyst Ming-Chi Kuo suggesting that Apple, the crown jewel of TSMC's client list, is seriously considering Intel's Foundry services for its future M-series processors. This is the moment the bears have been dreading. The expectation was that Apple would never leave TSMC. The reality is that geopolitical pressure and the sheer necessity of supply chain diversity are forcing the hands of big tech. If Intel secures even a fraction of Apple's silicon production, the valuation models that Wall Street has been using for the last 5 years are instantly obsolete. This isn't just about selling chips, it is about Intel proving it can manufacture the most advanced silicon in the world for the most demanding client in the world. When you combine this with the rumors of a Made in USA push from the administration, you get a perfect storm for a short squeeze and a long-term repricing of the stock. Let's look closer at what drove this 10% surge. It wasn't just retail enthusiasm. We are seeing institutional footprints all over this move. When a company the size of Intel moves this violently on a shortened Black Friday trading session, it tells you that the big money was caught off size. They were underweight, expecting the slow bleed to continue, and suddenly they had to chase. The news that Apple might utilize Intel's 2nm or 18A process nodes for future Mac chips completely upends the thesis that Intel is permanently behind. For years, the market believed Intel's Foundry ambitions were a money pit. Now we are facing the possibility that the smart money was wrong, and the aggressive build-out of fabs in Arizona and Ohio is about to pay off. We also have to consider the defensive moves by competitors. You have likely seen the headlines about TSMC suing Intel over alleged trade secret leaks involving hired engineers. While lawsuits are rarely good news, in this specific context, it signals fear. It suggests that the competitor which has dominated the landscape is genuinely worried about the talent and capability Intel is amassing. The sheer volume of trading we saw on Friday confirms that this is a liquidity event. Investors are rotating. They are looking at the massive run-up we have seen in Nvidia stock and wondering if the easy money there has been made and if the value trade is now in the beaten-down giants like Intel. It is a classic market psychological pivot. When everyone hates a stock, it takes very little good news to send it flying. But this isn't just good news. It is a potential validation of the entire IDM 2.0 strategy. If you are sitting on cash in your brokerage account, maybe you manage your own funds via Schwab Intelligent Portfolios, or you're active on Interactive Brokers, you have to ask yourself if you are allocated correctly for a semiconductor resurgence in the United States. The old strategy of just buying the leaders and ignoring the laggards might be the dangerous play for 2026. I want to pause here and ask you a question, because this divides the room every time. Comment below how many shares of Intel you currently hold, and do you trust them to actually deliver on these Apple chips, or do you think this is another false dawn? I want to see where the sentiment is really at. Now, let's establish what Intel actually is today, because it is not the same company it was in 2020. At its core, Intel designs and manufactures microprocessors for the global personal computer and data center markets. That is the bread and butter. But the exciting part, the part driving this stock price, is the Foundry business. They have effectively split the company internally. One side designs the chips, and the other side, the foundry, builds them. This allows the manufacturing arm to take orders from outside companies. Companies that used to be pure competitors can now be customers. This business model shift is risky and capital-intensive. It requires tens of billions of dollars in equipment, mostly from ASML, to build fabs that may not see profit for years. However, the logic is sound. The world needs more than one advanced chip maker, and the United States government is willing to subsidize the existence of a domestic alternative to Asian manufacturing. If you are an individual investor, perhaps you use Fidelity Investments for your retirement accounts or you trade actively on Robinhood app, you may be seeing Intel appear on top mover lists and wondering if it is too late to buy. The stock is hovering around 40.56 USD. Historically, Intel has traded much higher, but also much lower in recent memory. The key metric to watch here is not just the PE ratio, which currently looks distorted due to the massive investments eating into earnings, but the price-to-sales ratio and the forward guidance on foundry margins. If the Apple deal is real, the revenue quality improves drastically. Apple is a demanding customer, but they pay for quality and they provide massive volume. A contract with Apple serves as a seal of approval for other potential customers like Qualcomm or even AMD to potentially use Intel's fabs in the future. We also need to discuss the broader sector context. The semiconductor industry is cyclical. We have seen massive booms and busts. Currently, we are in an AI-driven supercycle. NVIDIA stock has been the primary beneficiary of this, capturing the lion's share of the data center GPU market. But AI chips need to be manufactured somewhere. As demand outstrips supply at TSMC, spillover demand is inevitable. Intel is positioning itself to catch that spillover. Furthermore, the AI PC emerging market, computers with dedicated neural processing units, is a segment where Intel still holds a dominant sway. If they can successfully launch their next-generation client chips while simultaneously bringing the foundry business online, they are fighting a two-front war that they might actually win. For those of you who engage in online investing, specifically if you use SoFi Invest or similar investing sites, you know that volatility is the price of admission. Intel is going to be volatile. The lawsuit with TSMC could bring bad headlines. There could be delays in the Ohio fab construction. The 18A node might not yield as well as hoped in the early stages. These are real risks, but the market is a forward-looking mechanism. It is pricing in the probability of success in 2026 and 2027 right now. The move to 40.56 is the market increasing that probability from unlikely to plausible. Let's touch on the mechanics of how you might approach this. If you are using Fidelity Wealth Management or even just the Fidelity mobile app, you have access to research reports that often go deeper than the headlines. You might notice that analyst ratings are starting to shift. For a long time, Intel was a consensus hold or sell. We are beginning to see buy ratings creep back in as the risk-reward ratio shifts. Similarly, if you are on Robinhood Investments or utilizing Robinhood Cash Management, the ease of entering a position means you can scale in. You don't have to dump your entire portfolio into Intel at $40. You can layer in. This is often a prudent strategy with turnaround plays. You want exposure to the upside, but you want to protect yourself if the stock retraces to fill the gap it just made. The comparison with Apple stock here is fascinating. Apple is known for its supply chain ruthlessness. They do not put all their eggs in one basket if they can help it. By diversifying to Intel, Apple gains leverage over TSMC. For Intel shareholders, this is the ultimate validation. It proves that the technology is up to par. The narrative that Intel cannot make 3nm or 2nm chips evaporates the moment a MacBook Air ships with an Intel-fabricated chip inside. It doesn't matter if the chip was designed by Apple, the fact that Intel built it is the victory. However, we must remain objective. The road ahead is filled with technical hurdles. Manufacturing at the Angstrom era, 18A, 20A, involves physics that is on the edge of what is possible. Intel is betting the farm on gate-all-around transistors and power via backside power delivery. These are buzz-heavy engineering terms, but in plain English it means they are trying to make chips more efficient and faster by rewriting the rules of how they are built. If they stumble here, the stock goes back to the 20s. If they succeed, the previous highs of the dot-com era or even the 2020 highs are back on the table. When you look at your Schwab Intelligent portfolios or your dashboard on Interactive Brokers, you often see a sea of red and green that can be overwhelming. The trick is to identify where the mispricing is. The market was pricing Intel as if it were going out of business or becoming a permanent second-tier player. The price action today suggests the market is waking up to the fact that the U.S. government and the world's largest tech companies simply cannot afford for Intel to fail. There is a political put option under this stock. The CHIPS Act was just the beginning. The strategic importance of a Western foundry is so high that Intel has a safety net that other companies do not have. The chatter on SoFi